A question that comes up a lot is, what is mortgage insurance and why do I have to pay for it? So I thought it would be worth the time to take a few minutes to talk about mortgage insurance. Now, this is primarily going to be focused on conventional loans. FHA loans also have mortgage insurance, but it's a slightly different animal. Simply put, mortgage insurance is something that is required if you're getting a mortgage loan and have less than 20% equity in the property. That's whether or not you're refinancing or purchasing. Now, one thing that's very important to know is that the mortgage insurance actually benefits the lender. It doesn't benefit the borrower. What happens is this. With so little equity in a property, the risk to the lender is greater, so they require the borrower to buy a mortgage insurance policy that, in the case of a foreclosure, and when the house sells, if it doesn't generate enough proceeds to pay the money back to the lender, the mortgage insurance kicks in and pays whatever the shortfall is. That's why you have to get mortgage insurance. It's very different than property insurance. This here is a pricing matrix chart for one of the big mortgage insurance companies, and I'm going to carefully go through it line by line. I'm just kidding. I would never do that. Now, there are a lot of moving parts, obviously, to a mortgage insurance policy, but it basically comes down to borrower qualifications and the structure of the deal, the equity in the property. The better the borrower qualifications, the lower the mortgage insurance premium. The smaller the equity, the higher the mortgage insurance premium. Also, there are two different ways that mortgage insurance can be paid. It can either be paid by the borrower as a separate line item on the mortgage statement, or it can be added into the interest rate and paid by the lender. Buyer paid and lender paid. Now, there are advantages to doing it either way, and the differences can be significant. Let's take a look at those. The advantages to lender-paid mortgage insurance are, number one, that it's fully tax deductible, and number two, there's slightly less cash to close because you're not having to set up an impound account. The advantages to buyer-paid mortgage insurance is that there's a slightly lower monthly premium and you don't have to refinance the house to get rid of it. So on the lender-paid side, the big advantage is the interest rate and the deductibility of that. So what they basically do is they figure out your base interest rate and then they increase the interest rate whatever amount is needed to cover the monthly payment. But because that interest is tax deductible, you owe less on your income taxes, and when you compare it out including the net tax benefit, having lender-paid mortgage insurance means that your monthly costs go down. On the other hand, with the borrower-paid mortgage insurance, when you get the 20% equity in the home, you can just have that insurance removed and you don't have to make that payment any longer. On the lender-paid side, that interest rate that you've paid extra for, that literally is with you for the life of the loan. So you're kind of going to have to figure out which of those two things, not only short-term, but long-term, is better for you. Now, if you'd like to talk about this further, or if you'd like to talk about my special buyer staging program, or you'd like to talk about the systems that I use and the 5 strategies that I employ to help buyers get a better price on a house, you can contact me. My number is 949-413-2371. You can also email me, michael@housemgroup.com. And if you're watching this on YouTube, there's been a little eye right up here in the screen. If you click that little eye, that'll take you to a site where we can set up a strategy session, either Zoom or in person, and we can talk further then. Thank you so much for watching and have a great day.